Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day, and I got a quick one for you today. You know, a lot of people ask me, should I look to invest in real estate, like single-family homes and things, or should I go just buy a REIT? Should I build up a REIT portfolio or a single-family home? This is actually a pretty hot topic, actually, and I think at the end of the day, you got to look at yourself and see if you're the type of person that can handle having single-family properties. Have you been through that? Have you had any sort of experience with it? Do you like getting in there and dealing with people, or do you just kind of want to invest in things and then have that liquidity? So there's a lot of arguments to make, and I'm just going to go with the data today and let you guys decide. Now, you know how when you invest in the stock market, people are always telling you, just invest in an index fund. You can't do better than the average anyways. What makes you think you're so good? And so they give you that argument, and you go, all right, fine, let me go in the index fund. Well, I've done lots of videos to show you how you can do better than index funds if you choose to, but you don't obviously need to do that unless you're sort of shooting for that, you're a younger investor. So we're going to take the same approach with investing. We're going to say, what's the average or median sales price in all these different areas around the United States, and what makes you think you can do any better? So let's just pretend that that's your benchmark there, and so we're going to see some comparisons between real estate and using some REITs. So if I can, I'll just dive in right into the charts, and thanks for sticking with me here. On the chart there, first you see the U.S. total existing median home sales price since, 1999. So we've got 20 years worth of data here. So in general, and let me add for you here, annualized, so that's going to be important. Okay, perfect. So here you go. Existing median home sales price change over the last 20 years. So you can see all through the 2008 mess how much everything suffered. But in general, everything looks good. You got a nice 110% return since, a little bit more than that, since 1999. The important part here to see is the average annualized returns, 3.7%, let's call it there. So let's pretend that that's it. Can you do any better than that? Well, what happens if you live in different areas? The actual data breaks down into different categories. So we can start with, let's start with the South, actually. There we go. So we're plotting the South, existing home sales prices, the median home sales change in the South versus the whole U.S. in general. So essentially what we're doing is we're saying the U.S. is the index. Now let's compare different areas to see if you can actually beat it. Well, we've got the South here doing a real touch better. Let's just call it even. A little bit more volatility, meaning a little more volatility to the downside there than we normally see. But that was I bet everything took a hit around that time. In general, you got just a couple percent difference in change. So far, the South is a little bit better than the index, but let's just call it a wash. It's not even all that exciting there. The Northeastern, we can check those prices there and see while they're an underperformer, this would be the equivalent of like some sort of slower fund relative to the market, right? So if you've got existing home sales still in the purple there, look at the blue here. This is the Northeastern. It is not as volatile. So again, when we talk about speed and volatility in investing, the same thing happens across the whole United States. In the Northeastern here, prices are not as volatile. They don't perform as well, and that's the trade-off. So you don't want to see as much fluctuation over the years in the price of your single-family home. Well, here you go. In exchange, you're going to have a little smaller return. So at the end of the time there, you got about a 98%, oh, there we go, 95.7% return, a little bit of an underperformer, 3.3% average return there. So far, the South beats out the sort of U.S. as a whole, but you could also choose the U.S. Let's go on to the Midwest. Out in the Midwest there, that's going to be your green line at the bottom. Not as great of a performing area. You could probably guess that so much. You sort of expect the Northeastern, the South, and the West to do really well. The Midwest, slower prices, a little lower volatility, but you don't miss out on much in terms of returns. You got an average of about 3.3% if you were trying to beat that. You get what we're looking at here, right? You good? So in the West, that's your hot pink line there, and hot pink does the best. In the West there, you have the best performance of about 4% average returns over the last 20 years. Now, in exchange for that, look at the volatility. This was, of course, one of your better performers right before 2008, and it turned into one of the worst performers, giving back more than almost every single area did, actually losing more than every area did So that's a wild ride. So right there, if we look at this compared to like stocks or ETFs or mutual funds, it's the same thing. We took a mass index, the U.S. existing median sales price change across the U.S., broke it down into different areas just to see if we could do better. So that's the performance of as far as the existing median sales prices, right? So if you're going to buy a single family home, there's the data, right? Your area may do a little bit better, a little bit worse, but there's the broad index. Now, the question was, could we just go invest in an ETF? Would it be better to do that? I just randomly picked a few. I swear I didn't really go through and spend much time on this. The ICF, I use this one a lot on the closing beat, so I just went ahead and plotted that one in here for you. Look at the change here with the ICF. That's going to be your light orange line back there, clearly outpacing overall. Now, just like anything else, if you want better performance, you have to expect more volatility. Most of the time, you're going to expect that unless you're hedging or doing something with derivatives there, but you get what I'm saying. More volatility. So through the 2008 mess, you had to hang on tight, but in general, you're going to outpace just buying a single family home in one of these areas over the last 20 years. Average change about 6% there. So the ICF averages about 6% over the last 20 years in annualized returns. And VNQ, we had to pick a Vanguard one. Everybody seems to love Vanguard, so we took the VNQ in there as well. Not quite as good as the ICF, but still an outperformer relative to the physical real estate prices. 85% return, and that's going to be your green line here. It's about 4.2% returns overall. But the issue with these are not as old. So if you happen to notice, can you see at the bottom? See how the dates changed a little bit? Right, that's because one of these doesn't go back as far. I think it's the ICF. Let me just take that off. Nope, I guess it's the VNQ. It's both of them. The ICF doesn't go back to 2000. So you see how the dates sort of tightened up there a little bit? So we're not getting as much data. So we're going back to inception on both the ICF and the VNQ. So that's the data that we have to work with there. But still an outperformer there. So something to keep in mind if you're taking a look. Just for fun, we really run out of data here. But we look at some of the single-family home individual REIT companies. Invitation Homes is in that category. Now, look, this only goes back to 2017, but clearly investing in the individual stocks, if you want to get that specific, that's going to be your orange or burnt sienna sort of number there. Invitation Homes doing well, and American Homes for Rent's the only other one that I know of. They're also, this is Invitation Homes now. American Homes for Rent down here in hot pink, just down on the individual stock level. I don't even really like comparing those. I think we're looking at a broad sort of the U.S. We're looking at areas of the U.S. That's kind of like looking at sectors in the market. I don't like the idea of going any further. So we'll just look at the ETFs there, and there's your performance. There's what you have to consider. So I hope that's something interesting for you. You can agree or disagree. I know real estate sort of just depends on where you're at. Like in our area, real estate's a little bit slower than some of the areas that surround us, and so it's hard to go by these sort of numbers. But those are your data points, and hope that helps. Hey, we'll be back at 5 o'clock today doing the Closing Beat. It's a live stock market update show that we do every single day to cover data like this, the good, the bad, and the ugly of what happened throughout the day. Did you see what happened to oil? Whoa, holy cow. We'll be covering that on the Closing Beat. So hope to see you there. Enjoy the rest of your day, and thanks for watching. If you would, hit the subscribe button and all that good stuff I'm supposed to ask you to do. Enjoy.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.